Something unusual is happening in certain American cities right now. Not a collapse. Not a crash. Not the kind of thing that makes the front page of the Wall Street Journal or triggers a Federal Reserve press conference. It's quieter than that. It's the slow, grinding sound of people deciding, one household at a time, that a place they once chose, once paid a premium for, once built a life inside of, is no longer worth it. U-Haul trucks leaving before dawn, for sale signs sitting on lawns for 90, 120, 180 days, apartments relisted at lower prices than last year, whole neighborhoods shifting from appreciating asset to holding cost. This is not a natural disaster. This is an economic one, and it is happening in slow motion in broad daylight, and most people living inside these cities haven't fully registered it yet. 7 cities, 7 different stories. But underneath each one, the same pattern. A gap between what these places cost and what they can realistically deliver. And when that gap gets wide enough, people leave. The question is, where and why, and what it means for the people still holding on. To understand what's happening at the city level, you have to start with a number that doesn't get enough attention. The United States has not built enough housing for decades, not even close. Freddie Mac has estimated the national shortfall at over 3.8 million units. That scarcity drove prices up, and for a long time, it masked a fundamental problem. Wages were not keeping pace. Then mortgage rates doubled. Between early 2022 and late 2023, the 30-year fixed mortgage rate went from roughly 3% to over 7%. That single shift effectively priced millions of buyers out of the market. A home that cost $350,000 with a 3% mortgage has a monthly payment around $1,476. The same home at 7%, over $2,300 a month, and that's not a rounding error. That's a lifestyle-altering difference. So buyers paused, but sellers, many of them locked into 3% rates they refinanced in 2020 and 2021, didn't drop prices to match. The result was a frozen market. Volume collapsed. Price discovery stalled. But here's what nobody talks about. The freeze didn't hit every city equally. In some markets, the ones with strong job pipelines, constrained land, or genuine population growth, prices held and the pain was temporary. But in other markets, the ones already facing demographic pressure, employer exits, or structural cost problems, something different started happening. The sellers who had to sell, estate sales, divorces, job relocations, landlords exiting the rental business, started cutting. And buyers, seeing the cuts, started waiting for more. And the psychology of a market that was always going up quietly began to fracture. What followed was not a crash. It was an exodus, not dramatic, not sudden, just persistent, directional, and accelerating in certain zip codes that are about to become very familiar. The question most people stopped asking is, what if San Francisco never fully comes back? For most of the 2000s and 10s, that was an unthinkable sentence. San Francisco was the center of the economic universe. The city where billion-dollar companies were born in garages and venture capital flowed like tap water. Then the pandemic came. Remote work became permanent for the tech sector. Companies shed office space. Foot traffic in the financial district and downtown core collapsed by metrics that would have been considered catastrophic in any other context. By 2023, office vacancy in San Francisco had climbed above 30%, the highest of any major American city. For context, a healthy commercial real estate market typically sits around 8 to 10%. At 30%, you don't just have empty buildings, you have a signal. The people who used to occupy those buildings aren't coming back. And when office workers leave, everything around them follows. Restaurants, retail, transit ridership, tax receipts. The city's budget shortfall reached into the hundreds of millions. Service cuts followed. And the residents who remained, many of them still paying among the highest rents in the nation, began asking a very reasonable question. What exactly am I paying for? Between 2020 and 2024, San Francisco County lost more residents than almost any other county in America. Not in percentage terms, in raw numbers. Real people, real households, real tax base, gone. The tech workers who could afford to stay left anyway, because they discovered something strange. They could live anywhere. And when you can live anywhere, you tend to ask, why here? The city is not abandoned, but it is hollowed. And the real estate market reflects it. Condos that sold for $1.2 million in 2019 are being relisted at $850,000 with no takers. The luxury market is sitting. The mid-market is sitting. And the ultra-luxury market, the Pack Heights penthouses and the Noah Valley Victorians, is the only segment performing. When only the very top of a market is working, the market itself is broken. Chicago is a city that has been quietly losing residents for longer than most people realize. Illinois has seen net domestic out-migration every single year for more than a decade. Not a bad year here and there. Every year. And Chicago is the engine of that state. So when Illinois bleeds, Chicago bleeds. The reason is not hard to find. Property taxes in Chicago are among the highest in the country. The city's pension system carries an unfunded liability that, depending on how you calculate it, runs into the tens of billions of dollars. And those pensions have to be paid somehow, which means taxes will not go down. The math does not allow it. For a homeowner, this creates a particularly cruel situation. The property taxes in certain Chicago neighborhoods can exceed $10,000 to $15,000 per year on a modestly priced home. In cities where the same money buys 4 times the house, Nashville, Raleigh, Phoenix, even parts of Texas, the comparison is not subtle. And the people who have the flexibility to make that comparison are making it. Here's the retention trigger. The people leaving Chicago tend to be the ones Chicago can least afford to lose. Middle-income earners, small business owners, young families just starting out, people who looked at the math, the taxes, the cost of living, the school quality, and decided the spreadsheet didn't work. What stays behind is a bifurcated city, a thriving high-income corridor along the lakefront and in certain northern neighborhoods, and a vast periphery of the city struggling with disinvestment, crime, and abandonment. That's not a Chicago problem unique to Chicago, but it's sharper there than almost anywhere. New Orleans is a different kind of story, and a more quietly devastating one. The city has always been vulnerable. Sitting below sea level at the mouth of the Mississippi, subject to hurricane seasons that are not getting milder, the physical risk of living in New Orleans has always been priced into the consciousness of its residents. But the insurance market is pricing it differently now. Louisiana has seen a mass exodus of homeowners' insurance providers over the last 5 years. Major carriers have pulled out of the state entirely. The ones that remain have raised premiums to levels that make ownership economically marginal for middle-class homeowners. Some residents are now paying $5,000, $7,000, even $10,000 per year for home insurance on homes that would list for $200,000 to $300,000. The math does not work. The monthly insurance cost alone rivals a mortgage payment. And when private insurers leave, homeowners are pushed to the state's insurer of last resort, which carries its own premium increases and coverage limitations. The word uninsurable is entering the conversation about entire zip codes in Louisiana. Once a zip code becomes uninsurable, lenders will not write mortgages for properties there. And when lenders won't write mortgages, buyers must pay cash. And the pool of all-cash buyers for flood-prone properties in economically stressed regions is not deep. New Orleans is not emptying, but the middle is leaving. And what that does to a city's culture, its tax base, its political will to invest, that story is still being written. Memphis rarely makes the lists. That's partly the point. On paper, Memphis looks affordable. Home prices are low by national standards. The cost of living is manageable. It sits in a state with no income tax. These surface statistics attract investors. And Memphis has, for years, been aggressively marketed to out-of-state landlords and small investors as a cash flow market. But beneath the affordability numbers is a structural problem that investors frequently discover too late. Property crime rates in Memphis are among the highest in the nation. Insurance costs have surged accordingly. Maintenance costs on older housing stock run high. Tenant turnover is chronic in certain submarkets. The result is a bifurcation between what the numbers say and what ownership actually costs, and a quiet erosion of the owner-occupied housing base that has long been the stabilizing backbone of American neighborhoods. The people leaving Memphis are not the wealthy. They are the working-class families who have watched their neighborhoods change, watched services decline, watched their property values stagnate while their insurance bills climbed, and decided that the promised affordability of the city has conditions attached that nobody disclosed up front. Hartford is a slow-motion case study in what happens when a city's economy and its governance fall permanently out of sync. Once an insurance capital, home to dozens of major carriers and the financial infrastructure that served them, Hartford has watched that industry consolidate, offshore back-office operations, and quietly downsize its Connecticut footprint for 30 years. What remained was a city with a very high cost of government and a shrinking tax base to fund it. Connecticut overall has some of the highest property taxes in the nation. Hartford itself has consistently ranked among the poorest cities in the country by per capita income, even while sitting in one of the wealthiest states. The suburban flight from Hartford is decades old. But what's new, and what nobody in the city's leadership wants to acknowledge loudly, is that the flight is no longer just to the suburbs. It is out of Connecticut entirely. Remote workers who no longer need to commute to Hartford are relocating to states where their dollar stretches further. Retirees are leaving for Florida, the Carolinas, and Tennessee. And younger residents who might have stayed are looking at the cost of starting a household in Connecticut and doing the math. The population of the state has barely grown in 2 decades. Hartford's has shrunk, and the demographic trends, an aging population, a declining birth rate, a lack of in-migration, point in only one direction. Austin is correcting. Whether it's a healthy correction or the beginning of a longer adjustment, that question is still open. Baltimore is the longest-running version of this story. It is a city that has been losing population since the 1950s. That is not a typo. 7 decades of consistent structural decline, interrupted briefly by moments of hope and investment that never quite reverse the underlying trend. What makes Baltimore relevant to a 2025 conversation is not that anything new is happening. It is that the forces now arriving in other cities, insurance stress, fiscal pressure, commercial vacancy, demographic aging, have been present in Baltimore for so long that the city is essentially a preview. And what Baltimore shows is that urban decline does not bottom out quickly. It compounds. The people with options leave. The tax base shrinks. Services decline, which makes more people with options leave, which further shrinks the tax base. There is no equilibrium in that cycle. There is only the next iteration. Baltimore still has extraordinary assets. Johns Hopkins, the port, proximity to Washington, a built environment of genuine beauty in certain neighborhoods. But assets do not automatically translate into reversal, and the trajectory, despite years of investment and intent, has not meaningfully changed. What happens next is not a prediction. It is a set of pressures that are already in motion. Insurance markets are not returning to 2019 pricing in climate-exposed regions. The models have changed. The losses are real. The carriers leaving Louisiana, Florida, and California are not planning to come back on the same terms they left. Mortgage rates, even if they moderate, will not return to the 3% era that inflated prices across the country. The buyers, who were priced out in 2022 and 2023, are still priced out. Many of them have restructured their lives around renting, and some of them are discovering they prefer it. Remote work has not been fully reversed. Despite return-to-office mandates from major employers, a significant portion of the workforce retains meaningful location flexibility. And that flexibility, once acquired, is not given back without a fight. As long as workers can choose where to live, cities that offer less safety, less affordability, less quality of life per dollar, will continue to lose them. The cities on this list are not all the same. Some are in temporary correction, some are in structural decline, some are facing problems specific to their geography and governance that other cities do not share. But they share one thing. The gap between what they cost and what they deliver has become visible. And once that gap becomes visible to enough people, the direction of movement tends to be one way. None of this is a sentence. Cities have come back from worse. Detroit still exists. Pittsburgh reinvented itself. Lower Manhattan was rebuilt after September 11th. Urban death is rarely permanent, but urban decline is real. And it tends to be underestimated at every stage because the people closest to it have the most incentive to believe it isn't happening. The homeowner who bought in 2021 does not want to believe their neighborhood is softening. The city official whose budget depends on property tax revenue does not want to believe the tax base is eroding. The investor who bought a portfolio of rentals does not want to believe demand is softer than it looks. Belief is not a hedge. The data that matters is not the narrative, it is the direction, population, transaction volume, days on market, insurance availability, school enrollment, commercial vacancy. These are the metrics that reveal what a city is actually doing. Beneath the story, it tells about itself. And in the 7 cities examined here, those metrics are pointing in the same direction, quietly, persistently, without headlines. Watch the numbers, not the narrative.